When you take a look at the big jump that we've seen in Chinese equities, both listed in the US and certainly domestically in Hong Kong and mainland markets as well, has the exuberance gone a little bit too far, or do you think that this is really the year where we see Chinese risk assets investable again?
Well, thank you very much for your invitation and Happy New Year to both of you. Now, somehow you catch us whenever we are slightly more optimistic about Chinese equities, and we happen to be in that position. Regarding the Chinese equities, we think the big rally that we have seen since the announcements regarding reopening late last year were really about the fact that the Chinese government had a total initiative against the market regarding these changes in public health policy. So that's basically done here. If you think about all the announcements that have come out of Beijing in past few weeks, now there's no turning back. There's definitely a shift to living with the virus arrangements going forward. Now the transition, it's not going to be smooth because consumers also need to adjust to the higher infection regime. So we are seeing in the higher frequency mobility indicators that there are some downside risks to growth. And what we think is more interesting for the markets is that going forward, this downside risk will be primary focus of the Chinese policymakers. So they have to do more in boosting growth, prospect going forward, and they need to relax restrictions for the industries. So that's going to come into focus, and we think there is scope for this rally to be sustained, until this transition is completely over, maybe by the second quarter of this year. So in the near term, we remain overweight in Chinese equities for this reason.
When you talk about value and quality dominating your portfolio ex-China, what about within China? Because you can clearly find value across a breadth of different Chinese stocks, right? What in particular is looking more resilient to you this year?
Well, we have to say that we are relatively balanced in terms of factor exposures in our Chinese equity allocation at the moment, which is a bit different from our global equity ex-China allocation, which is more tilted toward value and quality factors. The reason is that this transition episodes, basically, transition to living with the virus arrangements in China will definitely boost the growth potential for many of the sectors. And the whole market has been pretty cheap, and it still has some discount to the other markets as well. So in our view, the main driver right now is the macro and public health and policy. So for that reason, we prefer to be a bit more balanced in terms of factor exposures, because it's quite difficult to be very selective in this kind of environment. So that's basically where we stand regarding the factor exposures in China.
Homin, I find it really funny that you said that we catch you in these conversations every time you're actually more optimistic about China, which implies that you've been changing your calls about China as everybody else, right? What would lead you to become more negative about this market?
It's possible by the middle of 2023, the reopening process is quite visible and seems to be in the rearview mirror, and it'll be more about the willingness of the Chinese authorities to tolerate potential nascent inflationary pressures building up in the system, or other types of concerns about policy, maybe extent of policy accommodation. So maybe that comes into picture in the second half of the year. So going forward, I mean, in the very near term, we still remain quite constructive. But once we get the sense that the policymakers could want to be a bit more neutral, then that will be the trigger for us to change our mind.